Welcome to Market Wrap with Mo Ansari. In the next hour, Mo will analyze today's trading activity, fill you in on the latest news, and bring you the views of leading experts from around the world. You can email mo@compact.com. And if you miss any of today's show or just want to hear it again, visit our website at marketwrapwithmo.com for all the podcasts or the smartphone apps. Now, here's your host, Mo Ansari.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, and I'm going to talk about the market, what happened today on the 15th of September, 2021. What to expect tomorrow in between, whatever you want to know. Send me an email. Looking at the Dow, up 0.68% on the day. We were down 200 and some odd points yesterday, up 237 today at 34,814. S&P up 0.85% on the day, 4481. Nasdaq Composite up 0.82% on the day, 15,162. Nasdaq 100 up 0.78% on the day, 15,504. The Russell gained 1.11%, 2235. And interest rates higher today, up 2.7 basis points for 10-year at 1.304. 30-year was up 1.9 basis points at 1.869. Gold right back down today, down nearly $12 after yesterday popping up. Just can't hold on to any gains. It had 2 days of gains. Oil had a big day to the upside, highest close since July. Supplies were down for the sixth straight week. So let's take a look at all of this, what happened and why, and then we will take a look at some of the charts. I've got one of my great guests today will be joining us. Mr. Dr. Thornburg is going to join us. Always fun to talk to him and get his views, get his ideas, so what he is thinking, what he is doing, and go from there. So we will look at, he's also always has a great insight into the market. Market was all worried about, oh my God, you know, we're growing too fast. Inflation is running rampant. A couple of months ago, everybody was saying, oh, that's why, and the Fed is going to raise rates. So now, oh my God, we don't have enough growth. The economy is not growing fast enough that we might fall off. And so, you know, I had talked about this about 3 months ago. I said, that's what inflation was everybody was worried about. Now we don't have enough growth. That's what inflation has forgotten now. And everybody's saying we don't have enough growth now. So this is what we get from one day to the other. And it's just going back and forth. Yes, we do have a Delta problem, the variant problem. I think we're going to get past it. We're going to learn how to live with it. And, you know, we're going to get to herd immunity. People who don't have vaccinated, they'll get the virus, and people who've got the vaccination, they still get the virus, but they don't have severe complications. So we will get, once you get the virus, you develop, if you survive, you get the antibodies. So, you know, we're going to get there one way or the other. I think in the next month or two, we will be there where we will have people who are vaccinated and people who have the virus and they got the antibodies. So you add those two numbers up and we'll get to 85%, and that'll give us herd immunity. After that, every year we'll have to get a shot. If you don't get a shot, the people who don't get the shot will get the new variant, and we know the consequences. But that's reality. We can, you know, people's choices. People are making those choices for themselves, for their kids. And they all say, oh, I don't care if I get the virus. Then they get it. And they say, oh, please tell everybody, my God, I wish I'd taken the vaccine. I'm going to, you know, I never knew it was this bad. And if I knew it was going to be this bad, you see that all day long. But that's unfortunate. That's reality. And that's where we are. Nothing we can do about it. And it slowed down the recovery. Unfortunately, it slowed down the market a little bit because of that. But that's a choice a lot of people have made, because that's the country we live in, and that's the choices where we have the freedoms to make those choices. In China, you don't have a choice. They just put you in and say, hey, if you want to come out of your house, you've got to have a vaccination. That's it. But we don't live in China. We live in the United States. Ray Dalio is the founder of Bridgewater Associates. At last year's Davos event, he said, cash is trash. Wait a minute. He said that? I said that 10 years ago. He didn't say that. I said that cash is trash 10 years ago, if you remember, right on this broadcast. So many of you called me, Mo, what do you mean cash is king? How can you say cash is trash? I said, put it into work. Put it into the market. Cash is trash. And now it's going to get even more trash because of inflation is going to trash it. That's what it's going to do. But he was doing an interview today on CNBC. He was asked if he still feels the same, and this is Mr. Dalio had to say.
Of course, look, this is guaranteed. You are not going to have an interest rate that's going to compensate you anywhere for inflation. So you have to look at the cost of the money, right? And so that interest rate, whether it's the bond rate or whether it's the cash rate, certainly, you're not going to get that. And so we have this wonderful sugar high, which is to distribute the checks and so on. But that means everything else goes up in relationship to cash because it's better to borrow cash. That's just mechanics. So we have that dynamic underway. So we produce inflation. But what you do know is that interest rates must be below inflation rates and must be below the nominal growth rate in order to deal with all of that debt in order to finance it. And that depreciates the value of cash and money. So you have to invest it elsewhere. That's the dynamic.
Yeah, I understand that's the dynamic, but we've pumped in so much money into the system, and once this spigot gets turned off, where do we go? Do interest rates and the money supply has grown? And everybody is worried about inflation, saying inflation is coming. Probably it is. I like to see the velocity of money chart, which I show to you every now and then. When I do the YouTube updates, you can see those. And that's the velocity of money is what I look at. When that picks up, then watch out, because that is the rate of money circulating in the system. The faster it moves around in the system, the more inflation it causes. That's one of the things. But I haven't seen that in velocity pick up yet. When I do, that's when I say, okay, here comes inflation. Let's get ready. And then you have to have the right assets lined up in your portfolio that make money when inflation goes up. Yeah, there are inflationary assets also, but you have to know what they are. You have to do the research beforehand, and then you have to be able to make the changes. But as I said, last 3, 4, 5 months ago, when everybody was talking about inflation, I said, hold it. Don't do it yet until you start seeing the whites of their eyes. That's what I said. Some positions I gradually build up, as I'm doing in some of my positions now, where I see the opportunities. I don't put all my money in. I like them, and I'll build them over 2 or 3 months as I keep looking at that particular position, and I'll keep adding some of those positions to our portfolios. Dubravko Levkis is the JP Morgan's head of equity strategy. This morning, he announced an increase in this year's year-end target for the S&P to 4,700. During an interview on CNBC, he explained his call. This is what Mr. Levkis had to say.
It's a small upgrade. We're talking about a few percentage points. There's a lot of narratives. There's a lot of, call it, pessimism that's been sort of especially growing in the last 4, 5, 6 weeks. A lot of talk about late cycle dynamics, more structural, broader weakening. I think it's actually much simpler than that, and it's really come down to COVID and the fourth COVID wave and Delta that has resulted in definitely a delay in the labor market recovery process. Just look at leisure and hospitality. We're still missing about 1.5 million jobs there versus pre-pandemic levels. You have a bit of a negative impact on consumer sentiment on the back of that, and you've definitely seen a bit of a slowdown in broad-based economic and cycle data. But I think the view here, and the question here is really, what's the view on Delta? What's the view on COVID? Do things ease in the coming weeks, in the coming months? And if that's the case, I think everything we're talking about right now is displaced. I think we go back into some form of reacceleration and potentially a much healthier holiday season as far as 4Q is concerned, and a pretty decent setup when you think about the first half of next year.
Yeah, that's what I'm looking at is another acceleration. We had my 4440 target. We blew that away. So now you got to look at the next target that I put out on YouTube. You saw it, what I'm looking at. Dubravko Levkis was then asked how inflation plays into this. And this is what Mr. Levkis had to say.
One thing for sure, we are getting a ton of inflation and disruption, if you will, from COVID. And so I think if you take a view that a lot of these COVID-related pressures ease and these bottlenecks and disruptions start to ease, then I think automatically a lot of the inflationary pressures that we've been seeing will start to abate. Yesterday's CPI print maybe is a step in that direction. The only part of inflation that really worries me personally is what's the end game of ESG? What does that mean for potential imbalances that can create in commodities and specifically oil? But most of this other inflation, consumer inflation and so forth that we're seeing right now, I think is going to end up being more transitory. The U.S. consumer, I think, is in exceptionally good state to basically cope with somewhat higher prices. And again, inflation, first of all, is sequential increase in price. Right now, we're looking at a 3-month or 6-month increase in price. No reason why the U.S. consumer cannot cope with that. And I think that as Delta eases, automatically some of these inflation pressures that we're talking about right now will also ease in line with that.
Yeah, and if that happens, a little bit of price increases, a little bit of inflation is good, folks. It's not bad, especially if you own stock. If you don't own stock, yeah, it's terrible. You know, you go to the gas station, and if you are paying $4 a gallon, but you own some nice oil companies, you go, hey, they're making a lot more money. You're smiling all the way to the gas station. Companies have the opportunity to raise prices. When they raise prices, they make more money. When they make more money, their stock goes up. And guess what? You own it. And if you own it, you're doing well with it. That's how money is made when companies make money. If you're chasing this and chasing that, you're chasing a pipe dream. You're not going to get there. You know that. That's why you don't have any money, because you bought some stuff that somebody sold you and it was garbage, because they told you they're going to make you rich. And guess what? They made themselves rich, and you are saying, oh, what happened to my money? Well, if you make those kind of decisions, you're not going to make money. That's the problem. If you make, I'll be blunt, if you make stupid decisions, you're not going to make money. That's all there is to it. If you buy the get-rich-quick schemes, you're not going to get rich. There's no such thing as get rich quick unless you hit the lottery. You got to have a plan. You've got to be able to execute, and you've got to execute it over a period of time. You have to have a balanced portfolio. You have to have a financial planner. You've got to have somebody who's got 30, 40, 50, 60 years of experience. You've got to have somebody who's got a verified track record. You've got somebody who puts their own money at risk when they talk to you, not just your money. You got to have a financial planner that has a decade of information, a decade of experience. You've got to have somebody that does a financial plan, a retirement plan, a social security plan, an insurance plan, a tax plan. You have to have all of those things. And if you don't have it, you're not getting there, folks. Just buying one hot stock and trying to get rich, not going to happen. You're kidding yourself. It's a pipe dream. Somebody's selling it to you, and somebody says, oh, I'm going to buy you at the bottom, at the top, sell you at the bottom. Sell you at the top and buy you at the bottom. It's all garbage. People, who do that, they're all billionaires, not millionaires. They're billionaires. There are few people in the world who can do it. The rest of us, we've got to work very hard at it. And when you work hard at it, you're going to develop a plan, and that's how you're going to create wealth. That's how you go about doing it. I hear people, and it sometimes makes me really angry because they're just selling garbage. And people buy it. Well, that's buyer beware. There's one born every minute, as they say. And when I listen to this stuff, people work so hard for their money, and they save it after taxes, after all of this, and then they just give it away. Or they buy somebody's pipe dream of those get-rich-quick schemes. Don't buy those. Give us a call. We'll develop a plan for you. It is free. We'll give you a satisfaction guarantee. You come and become a client of ours, we'll do all the work. We'll do the financial plan, a $5,000 to $10,000 financial plan that we will do for you. And if you're not happy, you get to keep the financial plan. And I will give you all my fees back that I've charged you for the year. No questions asked. Do you have your financial advisor that will do that for you? Your annuity salesman is going to do that for you? Of course not. So pick up the phone, give us a call, and get going in the right direction. Stop doing all that other stuff that you're doing. Do something sensible and make money and get on the path at least to creating wealth, creating financial security. Pound 250 is all you have to dial and then say, talk to Mo. Pound 250 on the cell phone, talk to Mo. A member of my team, not an answering service, a member of my team is standing by right now to answer your questions. You can continue to do the same thing you're doing and expect a different answer. You know what that is called? I think you know that. Or you can try something different. Pound 250 on the cell phone, talk to Mo. Stay tuned. I'm going to take a short break, and I will be right back.
Be sure to visit marketwrapwithmo.com, the official website of Market Wrap, to find out which radio stations carry the show in your area or listen to the live audio stream online. And if you've missed any of the shows or just want to hear them again, we've got all of the archives right there on the site. marketwrapwithmo.com.
Welcome back, everyone, to Market Wrap. I'm Mo Ansari talking about the markets, what happened today, what to expect tomorrow. Is the party over, or is the correction over? I'll tell you a little bit later on when I take a look at the charts. S&P up 0.85% on the day. Best sector, energy up 3.82%. Industrials up 1.12%. Materials up 1.10%. Worst sector, utilities down 0.15%. Consumer staples only up 0.40%. And real estate up 0.41%. Oil had a big day today, up $2.15, or about 3.1% to close at $72.61 a barrel. That's how we are. That's where we were. We had the U.S. government data came out, showed that stocks dropped by 6 million barrels. And we are starting to see inventories come up, but they're down 6.4 million barrels. We are seeing production coming back up, but, we had Nicholas hit the Texas coast on Tuesday. It brought more rain, more devastation to areas in the Gulf Coast. These were already inundated, these areas, because of Hurricane Ida. In late August, we saw that. And production, there's still production. About 30% of the oil production is still offline. And that takes about 500,000 barrels a day off the market, off the production line. And natural gas, about 40% of that is still shut in. So we still have problems with all of the production, and we're using the stock or supplies where we are, and that's pushing up prices. Plus, I think as we get past Delta, and I think we will pretty soon get to the other side of Delta, I think oil price demand will come up, and supply is not there right now. So we could see prices continue. Once we broke the 50-day moving average on this, that was not on the crude oil market. Gold down big today, $12.30 lower, or 0.7%, $17.94.80 an ounce. I mean, yesterday with interest rates dropping, that should have caused the gold market to pop. It went up, but just barely struggled, barely got up there, and just collapsed, came right back down, cannot even get above the 200-day moving average. I mean, we see interest rates going down, and that should be good. We saw the dollar going down. That should have been good. But no, it just can't get out of its own way. When you get good news, it goes up a little bit. When you get bad news, it just plummets. I think, next week we're going to get the announcement from the Fed. I think that's what everybody is going to wait for. What kind of announcement we get from the Fed? Is it going to be, now people are saying, they're going to say, well, we are going to do tapering, and we are probably going to start at the end of the year, but we'll let you know. That's basically it. They said, and everybody expect that they will announce the tapering in November. They will tell us how much they're going to do per month. What is the composition? How much of treasury bonds, less treasury bonds they're going to buy? How much less mortgage-backed securities they're going to buy per month? That's the composition. And then the timing, how much they're going to do on a month, less they're going to do on a monthly basis. But for some reason, if they announce next week that this is the composition and this is the timing, I think that would be a pretty hawkish statement. That could be a surprise, and down we go in the market. Because market does not like surprises. It can handle everything else, but a surprise. Right now, the market's saying, okay, we're going to get we are getting prepared for the taper announcement. That's what we're going to get next week. The preparation for the announcement. Then we get the announcement in November, then the tapering in December. That's how we go. And that tapering should last until the middle of next year. And then we'll see how the economy is doing. And I think the biggest thing that we have to look at is taxation. How much deficit spending we do and how much we do in taxation with the new social infrastructure bill. That's what it's called by the Democrats. I just call it the tax bill. How much we're going to find, how much taxes we're going to pay more, and what kind of if they take away the deduction for IRAs bigger than $10 million, I don't care. That's fine. I mean, somebody who's got $5 billion in their IRA, They've got to pay tax. I don't care. They've got too much money. And there's a loophole in the IRA, in the Roths, that you put in stocks that you bought at pennies a share, because you buy them, and then that company goes public, and all of a sudden that stock is worth $200 a share. Now the pennies per share to 5 million shares that you have is worth whatever, $1 billion, whatever. But it's all tax-free. There's no tax on it. Then you can take it out and spend it tax-free. Wait a minute. Can you and I do that? Yeah, probably, if we were going to take our company public, but we didn't. Let me go to a break. Pound 250 on the cell phone. Talk to Mo. Call me right now, and I'll be more than happy to help. Stay tuned, and I will be right back.
Financial news and information you can trust. This is Market Wrap with Mo Ansari.
Money.
Welcome back, everyone, to Market Wrap. I'm Mo Ansari. And on our guest line today, Dr. Christopher Thornburg. He's the principal and founding partner of Beacon Economics. Dr. Thornburg is an expert in economic and revenue forecasting, regional economics, economic policy, and labor and real estate markets. He became nationally known for forecasting the subprime mortgage market crash that began in 2007, and one of the few economists on record to predict the global economic recession that followed. From 2008 to 2012, he served as the economic advisor to California State Controller's Office, and in 2015 was named chair of California State Treasurer John Chang's Council of Economic Advisors. He's appeared on CNN, Fox News Channel, Bloomberg TV, and is regularly quoted in the Wall Street Journal and New York Times. Dr. Thornburg, welcome back to Market Wrap.
Nice to be here, Mo.
You talked about the real estate market, and you were one of the first who predicted that we could have a crash in the real estate market. I want to look across the world, and right now we are getting reports that the Chinese real estate market is crumbling. Have you looked at that market at all, and do you think it has any similarity to what happened here in 2008 to 12?
Well, I got to be honest with you. A lot of the data we get out of China is a little bit sketchy. So from my perspective, I'm a little hesitant to, shall we say, weigh on whatever the current trends are. It has certainly been the case that in China, where savings is, it's something that has been politically promoted for decades, and it has led to the nation having one of the highest savings rates in the world. But the problem with too much savings is that it can create, if you will, problems in asset valuation. The Chinese are so encouraged to save. The question is are there assets worth putting money into? Will they actually create some sort of good return from the long run? We know that the fundamentals between the value of real estate and the kind of rental gains they can actually get in that market have been out of whack again for decades. Does it seem like this whole thing could come unwound at some point in time? Absolutely, it could. But I would also point out to folks that they don't have a market economy the same way we do, and ultimately the Chinese government can, shall we say, twitch their nose and make crises go away, at least in the short run.
Let's talk about the Fed and inflation. The Fed says inflation is transitory. Some disagree, and all can see the prices are rising fast. What is your view on inflation? What is the long-term impact for the economy?
Right. Well, you're absolutely right. The Fed's been using the same sort of line all along here, which is that we're seeing today is largely transitory. And I actually agree with that. Look, they have loaded this economy up with so much cash because of the excessive fiscal policy that aggregate demand right now is higher than it's ever been. The supply chains in our economy aren't capable of keeping up with that level of demand. Ergo, we're seeing these sharp increases in prices. Where I get a little frustrated is where Powell seems to be indicating that because this is transitory inflation, there must be no risk of long-run structural inflation. And that's where I say, no, time out. Just because this is transitory inflation doesn't mean long-run structural inflation isn't a risk. It absolutely is a risk. The kind of money they pumped into the economy has created one of the biggest increases in money supply we've ever seen. The amount of money we have in our economy relative to the size of our economy has never been this high. And obviously that combined with, if you will, a big surge in aggregate demand, both by excessive fiscal spending as well as, again, this incredibly strong consumer spending. And to me, that sounds like a recipe for inflation. So I am worried about it. I think that when Jerome Powell stands up and says it's not an issue, he's gaslighting everybody. To me, it's absolutely an issue, and it very much worries me. There's no doubt about it. But again, with all that in mind, I think that the inflation we've seen over the last few months really is transitory. The question is it going to convert into long-run inflation? And my guess is almost assuredly yes.
The Fed Chair Jay Powell's term ends in 2022, and many are speculating that he won't make any moves until he's reappointed. Do you think his reappointment will impact his decision on tapering?
Well, asking me the motivations of a politician, who knows, right? I couldn't possibly suggest one way or the other. What I do know is surely among the legions of economists who form the ranks of the bureaucracy at the Federal Reserve, that there's more than one of them who understands the risk that the Federal Reserve Board is taking right now with this excessive monetary policy. But let's remember the people who actually run the Fed, the people on the board, Jerome Powell himself, these folks aren't economists, they're politicians. That's how they got to the Federal Reserve Board in the first place. And, you know, when you think about where politicians are right now, despite the fact that the economy is back, we've almost completely healed from the hit that happened to the economy last year because of the pandemic, yet no one in government at the federal level or at the local level is willing to acknowledge that the crisis is behind us. Every politician knows that you can make a name for yourself in times of crisis. Ergo, they are not willing to let a crisis go by without milking it for all it's worth. And candidly, whether we're talking about Congress, whether we're talking about the Federal Reserve, whether we're talking about the folks in Sacramento, they are milking this to the point where they're actually creating more harm to the economy than good.
Let's start talk a little bit about Biden's tax plan. Or the infrastructure spend, whatever you want to call that, the social infrastructure. They're talking about $3.5 trillion. Do you think this is going to have a negative impact on the economy, or this is going to, how is it going to help or hurt the economy?
Well, a lot of it will depend on how we pay for it. Look, I'm not one of these folks who thinks that high taxes kills economic growth. That's nonsensical. We know better than that. The range that taxes move within the United States system is such that it doesn't really have any impact on long-run economic growth. It just doesn't. For me, the greater risk to the economy is the fact that our federal debt is spiraling out of control. We entered the pandemic with $1 trillion structural deficit, thanks to Congress and Trump basically cutting taxes and blowing out spending. We started that year with $1 trillion deficit. We've now borrowed $5.5 trillion over the course of the last 2 years. We're almost surely going to be borrowing a couple trillion more in the next fiscal year. And the question is at what point in time is too much too much? And here's my real concern. Here's the thing that keeps me up at night. You have two things happening simultaneously. You have the government spending like there's no tomorrow, borrowing like there's no tomorrow, and then you have the Federal Reserve putting money into the economy, again, like there's no tomorrow. Well, one of the reasons that all this federal debt hasn't amounted to much from an economic standpoint is the fact that carrying this debt is so cheap. It's amazing. For all the debt that the federal government has picked up over the last, say, 4 or 5 years, overall, the interest payments as a percent of GDP have been steady, and that's because interest rates have continued to fall. But eventually, inflation kicks in, and eventually the bond markets react, and you could end up in a situation in 3 or 4 years from now where the government, where our nation is facing two headwinds simultaneously. One is the Federal Reserve driving rates up to push inflation out of the system, even as the federal government is suddenly forced to ration because their debt cost control, their spending on Medicare and Social Security are out of control, and the bond market simply will not let them borrow anymore. That talks about a big, sharp increase, a decrease in increase in taxes or a decrease in federal spending. You put those things together, and that's a shock that can create a much worse recession than what we just went through. In other words, all this effort, if you will, to save an economy that doesn't need saving could ultimately lay the seeds for the next recession, which is going to be substantially worse than what we just went through.
There's a lot of concern talking about debt, the debt ceiling right now, especially those who remember how long the last government shutdown lasted. Do you think there will be a resolution before the government shutdown, or we could have to go to a shutdown, and after that week or two, they figure it out?
Again, you're asking me to make a political forecast, Mo. Please, I'm an economist, okay? Don't do that to me. But to be clear, it is absolutely the case that when the Republicans have a Republican president, they don't care about deficits. But when the Republicans have a Democratic president, they do care about deficits. The hypocrisy there is obnoxious to the nth degree. But putting that to one side, this is exactly when, of course, they decide to flex, if you will, their political muscles. They'd rather shut the government down because now that Trump is not president, suddenly they found fiscal balance, if you will, something that's important to them, and they may push hard to stop this from happening.
We are talking to Dr. Christopher Thornburg. He is the principal and founding partner of Beacon Economics. Dr. Thornburg, home prices are rising fast, and they have, as they have in the past year. There's talk of another housing bubble. You call the last one? Do you see another one?
Nope, not even close.
Why?
Well, look, a bubble is not defined by rapidly rising prices, okay? That can be a symptom of a bubble, but it is not a definition of a bubble. Now, a bubble, when you think about a bubble, what you have to think about is something happening in the market which is unsustainable from a long-run perspective. Overbuilding, overborrowing, or some diminishment in the credit capacity of borrowers, these are all things to be scared of. Mm-hmm. None of those things are happening. This nation is still incredibly scarce in housing, the state even more so scarce of housing. There's no excess supply problems the way that many parts of the economy had, say, back in 2007 and 2008, like Florida and Arizona. Number two, credit markets remain remarkably strong, both in terms of the fact that overall debt is really not rising rapidly. Even now, it's not rising rapidly. Yes, there's been a lot of mortgage activity, but it's mainly people refinancing. And then last but not, and of course, the quality of their credit is amazing. 85% of new mortgage debt is going to people with credit scores over 720. So this is clean stuff. And then last but not least, one thing to look at is what I would call the affordability. Now, I know that there are groups out there that create affordability indexes where they compare the price of a home compared to median income. That's a nonsensical measure. What you need to be paying attention to is the price of a home relative to the buyers. And I look at that by considering the share of income for homeowners being spent on servicing your house, mortgage, taxes, all that kind of stuff. Well, you know, in 2011, take California, for example. In 2011, almost 40% of homeowners in the state of California were housing cost burdened. That is, they were spending well over a third of their income on mortgages, taxes, all that kind of stuff, which is an enormous burden on a family. As much as prices have gone up between 2011 and 2020, believe it or not, the share of housing cost burdened households has fallen from a little less than 40% to a little less than 30%.
So it has gone down.
Substantially lower. And what that means is that housing is still affordable for the people who are buying. Yet again, nothing to be worried about. This is not a bubble. If you're worried about bubbles, pay attention to the stock market.
Let's talk a little bit about the economy. What is quickly, we have about 30 seconds left, your outlook for the economy, short-term and long-term?
The economy's fine. We bounced back much quicker than a normal recession because it wasn't a typical type of recession. Recessions are typically driven by demand shocks, which can have long-run influences. This was a supply shock, And even though we're dealing yet again with some of those supply issues, the economy is just fine. The big risks in our economy today, again, is a Federal Reserve and a Congress who don't seem to understand that the economy's fine, and they continue to stimulate it to the nth degree, makes the economy look hot, hot, hot right now. But I'll tell you, out there, the sugar rush is going to turn into a sugar crash. And the question is, will that crash be enough to push us into a real recession? Only time will tell.
Dr. Thornburg, as always, it's a pleasure to have you on the broadcast. Thank you for sharing your thoughts with us.
A pleasure to be here.
That's Dr. Christopher Thornburg. He is the principal and founding partner of Beacon Economics. Stay tuned. I'm going to take a short break, and I will be right back.
Register now for Mo Ansari's Lunch and Learn Seminar on Wednesday, October 6th in Scottsdale. You can also make an appointment to meet with him on Tuesday, October 5th or Wednesday, October 6th and get your free portfolio review. Space is limited, so dial pound 250 on your cell phone right now and say, "Talk to Mo," or register online at compact.com. That's COMPAK.com.
Welcome back, everyone, to Market Wrap. I'm Mo Ansari. That's why I like talking to Dr. Thornburg. He is great. I enjoy talking to him. We should have him more often on the broadcast. I'll talk to Bobby and see if we can schedule him more often, once every 2 or 3 months, not once every 2 or 3 years. Looking at the market across, let's see, what do we have? Let's take a look around the world, if I can find those numbers here. And then we're looking at S&P at 0.85%. Great day today. Looking at London was up, down 0.25. France was down 1.04. Germany was down 0.68. Spain was down 1.65. Italy was down 1.02. Tokyo was down 1.06. And Brazil was down 0.89. So everybody was down, but they were catching up from yesterday. Yesterday, these markets were slightly higher. We were down. So now we went down yesterday. So it caught up today. Now we're up. So they'll catch up tomorrow. That's what we're looking at. So nothing particularly exciting. Let's go and take a look at the charts and see what's going on there. S&P has come down and tested the 50-day. Yesterday, the 50-day moving average was 44.29. Low was 44.31. Today, the moving average was 44.31.79. Low was 44.38. So we came very close to the 50-day moving average. We've done this a few times. We did it in May. We did it in June. We did it in July. And we got close in August, and here we are. And every time we come down to this level, we pop right back up. We can't. I mean, it just comes right. Last time we got below it for 2 days was in March, and then we haven't. And that's how stable this market has been. And again, is the correction over? I don't know. People are waiting to get in because, I'm waiting for that 10%, 5% correction. You've been waiting for 10 years. You've missed the best opportunity in your life to invest because you bought into the gloom and doom. You bought into the negativity of all of the stuff that people sell, all the fear that they unfortunately, and you got pushed out of the market because all of this garbage that these people said. And all they do is they sell fear and they talk about politics because they can't talk about anything that they have done for their clients, anything that they have created wealth for their clients. They can't show that. That's why they talk about everything else. I talk about money. I talk about a verified track record. I talk about how you can come to us, use our services for a year. If you're not happy, I give my money back to you. All the money that you paid to me as a fee, I give it back to you. Why doesn't anybody else do that you hear on the radio? Because they can't. They're selling you a pipe dream, not reality. They don't have a real product. Everybody sounds great on the radio, but they don't have a real product. They're selling you garbage, and that's why they can't guarantee their work, give you a satisfaction guarantee, give you a free trial for the year. They don't have the 40, 50, 60, 70 years of experience of doing this. They don't have the depth, the knowledge. That's what you get. You get a team that works with you. Usually the minimums are $1 million, $2 million, and some firms that do these do what we do, charge minimum $5 million to open an account with them. I try to keep it as low as possible for you to come to us so we can help you. Because a lot of my clients come from the radio broadcasts. They're not all the country club members. I have clients that work hard for their money, and that's what we want to do is give you the world-class, what we believe are world-class solutions, and give you the very best. I can't control the market. No one can. But you get somebody who's a fiduciary who has to look out for your interests first. By law, we have to do that. That is the law. We're not going to sell you something that's just going to be making us a commission and does not for your interest. Ask the people who are selling you, are they fiduciaries? Are they going to do they have a verified track record? Show it to you in writing, not a hypothetical. Now, be careful of those. People say, look, if you had been invested like this is how much money you would have made. Yeah, if you had bought Microsoft in 1990, you would have been 30 years later, you would have been a billionaire. That's how it could have, would have, and should have. What happened in reality to your clients? Show me that. Give it to me in writing. Don't show me. Give it to me in writing. That's what you need to do to get somebody. A verified track record. Get a satisfaction guarantee. Look at their credentials. I mean, my brother is a professor. He's on the investment team. He's worked with me for 20 years. He's a professor of finance. He teaches wealth management to the MBA class at the University of California, Irvine. He's a professor. He teaches wealth management. You want somebody who does that to help you? Do you think they have some knowledge about the markets? Pick up the phone, give us a call, and get going. That's what you need to do. Don't sit there and say, well, I could have, Mo, I've been thinking about it. No, get it done, and get it done now. Call pound 250 on the cell phone and say, talk to Mo. Support on the S&P is 44.31. Breaks it, it's going to go lower. I think it's going to bounce here. I think we can now get above 4,500. I think we go towards 4,600 now. Looking at the NASDAQ support, we went back above the 20-day now. 50-day support at 14,855. That support. Resistance is the all-time high. Gold had a terrible day today. Yesterday it came and kissed the 200-day. Closed close to it. Today it kissed it, which is at 1799. And then it just fell right back, closing at 1795. That's all the time that I have today, folks. Again, if you want us to help you, get you going in the right direction, you have to take the initiative. It's not going to happen by itself, but you have to at least try. You work hard for your money. Why don't you have your money working as hard as you do? Pound 250 on the cell phone. Talk to them. I'll pick up the phone. Give us a call. We will be more than happy to help. There's a member of my team standing by who's got a decade of experience or more. Usually a couple of decades of experience. And he will be or she will be more than happy to answer your questions. At least get you pointed in the right direction. Get you started. No cost, no obligation. Pound 250 on the cell phone. Talk to Mo. Pound 250 on the cell phone. Talk to Mo. That's all the time that I have today. You've been listening to Market Wrap. I'm Mo Ansari. I will be back at the same time tomorrow. Until then, good trading.
Mo Ansari's opinions about specific investments are not investment advice or recommendations to any individual listener. Mo's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. Compact Asset Management and its clients may own some of the investments callers ask about. Therefore, Mo may have an interest in giving a favorable or unfavorable opinion of the investment. Because of time limits, individual investments owned by Compact and its clients cannot be specifically identified. The information on Market Wrap does not constitute a solicitation of the sale or purchase of securities. You should consult a professional financial advisor before executing a security trade or taking any other action based on information contained in this program. Customer Funds Custodian, Fidelity Institutional Wealth Services, Compact Asset Management, Compact Securities, and Mo Ansari are registered investment advisors, member FINRA SIPC.